Question 1. Topic: Formation and operation of captive insurance companies. Which of the following best describes the purpose of a feasibility study during the formation of a captive insurance company? A. To comply with statutory accounting principles required by the Kentucky Department of Insurance. B. To evaluate the financial, operational, and strategic benefits of forming a captive. C. To identify the necessary reinsurance agreements needed for the captive to operate. D. To determine the most cost-effective jurisdiction for reinsurance coverage. Answer: B. To evaluate the financial, operational, and strategic benefits of forming a captive. Explanation: a feasibility study is crucial to assess whether establishing a captive insurance company is financially and operationally viable. It involves evaluating risks, conducting actuarial analyses, and estimating costs and benefits. A. Incorrect. Statutory accounting principles are related to financial reporting after a captive is operational. C. Incorrect. While reinsurance agreements may be part of the plan, they are not the primary focus of a feasibility study. D. Incorrect. Selecting a jurisdiction is part of the formation process but is not the sole purpose of the feasibility study. Relevant law guidelines. The Kentucky Department of Insurance requires detailed financial projections and risk assessments, which are core components of feasibility studies, to ensure solvency standards are met. Question 2. Scenario-based. Topic: Taxation and legal considerations. Ms. Rivera owns a mid-sized manufacturing business in Kentucky. She is considering setting up a micro-captive under Section 831(b) of the Internal Revenue Code to manage her company's risks more effectively. She plans to insure against supply chain disruptions and workplace injuries. However, she also wants to ensure compliance with federal and state regulations while taking advantage of tax benefits. What is the most critical step Ms. Rivera should take to ensure a micro-captive's compliance and legitimacy? A. Avoid insuring risks that are already covered by a commercial insurer. B. Ensure premiums charged by the micro-captive are reasonable and based on actuarial analyses. C. Elect for the captive to be taxed as a C corporation under Kentucky tax law. D. Use the micro-captive exclusively for tax savings without formal documentation of risk management. Answer: B. Ensure premiums charged by the micro-captive are reasonable and based on actuarial analyses. Explanation: micro-captives under Section 831(b) must meet strict guidelines to be considered legitimate by the IRS and state regulators. Premiums must reflect actual risks and should be supported by actuarial data to avoid being classified as abusive tax shelters. A. Incorrect. Ensuring unique risks is important, but it does not solely guarantee compliance. C. Incorrect. Tax election as a C corporation relates to corporate structure, not directly to compliance. D. Incorrect. Using the micro-captive solely for tax purposes without risk management is prohibited and flagged by the IRS. Relevant law guidelines. IRS guidelines on micro-captives emphasize the need for proper risk assessment and documentation. Kentucky tax statutes also regulate premium taxes for captives operating within the state. Question 3. Topic: Underwriting and claims management. Which of the following best represents a key consideration in the premium setting process for a captive insurer? A. Premiums must be competitive with commercial insurers to attract external clients. B. Premiums should be calculated based solely on historical claims data. C. Premiums must align with actuarial projections and reflect the risk profile of the insured entity. D. Premiums should exceed the market rate to ensure adequate reserve levels. Answer: C. Premiums must align with actuarial projections and reflect the risk profile of the insured entity. Explanation: Premium setting in captive insurance must balance affordability and adequacy to cover risks. Actuarial projections are essential for ensuring that premiums correspond to the insured risks while maintaining financial solvency. A. Incorrect. Captives are designed primarily to serve the needs of their parent companies, not to compete with commercial insurers. B. Incorrect. While historical claims data are important, premiums must also consider future risk exposures and changes in the insured's operations. D. Incorrect. Excessive premiums could lead to regulatory scrutiny and undermine the captive's purpose. Relevant law guidelines. Kentucky statutes require captives to adhere to financial solvency standards, and premiums must be actuarially sound to meet both state and federal regulatory requirements. Question 4. Topic: Kentucky-specific captive insurance regulations. What is the minimum capital and surplus requirement for a captive insurance company to be authorized in Kentucky? A. $250,000 for pure captives or $1 million for group captives. B. $500,000 for pure captives or $1,500,000 for group captives. C. $1 million for pure captives or $2,500,000 for group captives. D. $2 million for all captives regardless of type. Answer A. $250,000 for pure captives or $1 million for group captives. Explanation: Kentucky Revised Statutes (KRS) specify different minimum capital and surplus requirements based on the type of captive insurance company. Pure captives require $250,000, while group captives require $1 million to ensure financial stability. B. Incorrect. These amounts exceed the actual statutory requirements for Kentucky captives. C. Incorrect. These figures align with high-tier captives or other jurisdictions. D. Incorrect. Kentucky does not impose a uniform requirement for all captives. Relevant law guidelines. Kentucky Revised Statutes KRS 304.49 detail these minimum requirements for captives operating in the state. Question 5. Scenario-based. Topic: Risk management practices. Mr. Cheng is the CFO of a healthcare organization operating a captive insurance company in Kentucky. He notices an increasing trend of malpractice claims against physicians employed by his organization. To mitigate future risks, he considers enhancing the captive's risk management practices. Which of the following strategies would be the most effective initial step for Mr. Cheng? A. Immediately increase the captive's reserves to cover potential claims. B. Introduce mandatory training programs on malpractice prevention for physicians. C. Purchase reinsurance for all malpractice claims above a certain threshold. D. Shift all malpractice coverage to a commercial insurer. Answer: B. Introduce mandatory training programs on malpractice prevention for physicians. Explanation: Implementing preventive measures such as training programs directly addresses the root cause of malpractice claims, reducing the frequency and severity of incidents. A. Incorrect. Increasing reserves is a reactive measure and does not prevent future claims. C. Incorrect. Reinsurance is a financial risk transfer tool, not a risk reduction strategy. D. Incorrect. Transferring coverage to a commercial insurer defeats the purpose of operating a captive. Relevant law guidelines. Kentucky Department of Insurance emphasizes proactive risk management as part of the governance requirements for captives. Question 6. Topic: Ethics and professional responsibility. Which action is considered unethical for a captive insurance manager under Kentucky regulations? A. Disclosing financial solvency concerns to the board of directors. B. Establishing clear conflict of interest policies. C. Using captive funds to finance unrelated personal investments. D. Conducting annual audits as per statutory requirements. Answer: C. Using captive funds to finance unrelated personal investments. Explanation: Using captive funds for personal purposes is a direct violation of ethical and regulatory standards. Captive funds must be used exclusively for business operations and risk management. A. Incorrect. Transparency regarding financial solvency is essential for ethical governance. B. Incorrect. Conflict of interest policies are a requirement for governance. D. Incorrect. Conducting annual audits is mandated by the Kentucky Department of Insurance. Relevant law guidelines. Kentucky Revised Statutes and regulatory guidelines emphasize ethical use of funds and accountability in captive operations. Question 7. Topic: Financial management for captives. What is the primary purpose of maintaining reserves in a captive insurance company? A. To enhance profitability through investment strategies. B. To meet statutory requirements imposed by the Kentucky Department of Insurance. C. To ensure funds are available to pay for future claims. D. To allocate surplus funds for parent company operations. Answer: C. To ensure funds are available to pay for future claims. Explanation: Reserves are critical for covering future liabilities and ensuring the captive's financial solvency. This aligns with regulatory requirements and sound financial management. A. Incorrect. Investment strategies are secondary to maintaining adequate reserves for claims. B. Incorrect. While reserves help meet statutory requirements, their primary purpose is to cover claims. D. Incorrect. Surplus funds must be used for captive operations, not parent company expenses. Relevant law guidelines. Statutory accounting principles (SAP) as enforced by Kentucky regulators emphasize reserve adequacy for claim payouts. Question 8. Topic: Captive market dynamics. Which trend is currently reshaping the captive insurance market in Kentucky? A. Increasing use of captives for cyber risk management. B. Elimination of premium taxes for group captives. C. Decline in the formation of risk retention groups. D. Introduction of captives exclusively for employee benefits. Answer A. Increasing use of captives for cyber risk management. Explanation. Cyber risks have become a significant concern for businesses, and captives are increasingly being used to provide tailored coverage for these exposures. B. Incorrect. Kentucky still imposes premium taxes on captives, although incentives exist. C. Incorrect. Risk retention groups remain a viable structure for specific industries. D. Incorrect. Captives for employee benefits are common but not the primary current trend. Relevant law guidelines. Trends in the captive market often align with evolving business risks, with cyber insurance being a focal point in modern risk management. Question 9. Topic: Underwriting and claims management. What is a key consideration when customizing coverage for a captive insurance policy? A. Ensuring coverage aligns with standard policies offered by commercial insurers. B. Including all potential risks, regardless of their likelihood. C. Tailoring coverage to meet the unique risks of the parent company. D. Avoiding coverage for high-frequency, low-severity risks. Answer. C. Tailoring coverage to meet the unique risks of the parent company. Explanation. Captive insurance allows businesses to design policies that address their specific risk profiles, offering flexibility unavailable in commercial markets. A. Incorrect. Captives provide custom solutions that often differ from standard policies. B. Incorrect. Including unlikely risks is inefficient and may inflate costs unnecessarily. D. Incorrect. High-frequency, low-severity risks can often be effectively managed within a captive. Relevant law guidelines. Kentucky statutes permit significant flexibility in designing captive policies to address specific business risks. Question 10. Scenario-based. Topic: Reinsurance and fronting arrangements. Dr. Patel operates a pharmaceutical company that uses a captive insurer for product liability coverage. To expand operations, he wants to leverage a fronting arrangement with a commercial insurer while maintaining risk control through his captive. What is the most critical consideration for Dr. Patel in structuring this arrangement? A. The fronting insurer's ability to transfer all risks to the captive without oversight. B. Ensuring the fronting insurer retains significant financial exposure. C. Compliance with Kentucky's financial solvency and risk transfer requirements. D. Utilizing the captive to cover all risks without third-party involvement. Answer. C. Compliance with Kentucky's financial solvency and risk transfer requirements. Explanation. Fronting arrangements must comply with regulatory requirements, including ensuring the solvency of the captive and proper risk transfer mechanisms. A. Incorrect. Oversight by the fronting insurer is critical to validate the arrangement. B. Incorrect. Fronting insurers typically transfer most risks to the captive. D. Incorrect. Risk transfer to third parties like fronting insurers is a key aspect of captives. Relevant law guidelines. Kentucky's DI regulations require fronting arrangements to meet solvency and risk-sharing standards. Question 11. Topic: Regulatory compliance for captives in Kentucky. What is the required frequency of financial reporting for a captive insurance company operating in Kentucky? A. Quarterly reports to the Kentucky Department of Insurance. B. Semi-annual reports to the Kentucky Department of Insurance. C. Annual reports including a certified audit. D. No mandatory reporting requirements. Answer. C. Annual reports including a certified audit. Explanation. Captive insurers in Kentucky must submit annual financial statements, including a certified audit, to ensure compliance and solvency. A. Incorrect. Quarterly reports are not required for captives in Kentucky. B. Incorrect. Semi-annual reporting is not mandated. D. Incorrect. Reporting requirements are explicitly stated under Kentucky statutes. Relevant law guidelines. Kentucky Revised Statutes KRS 304.49 mandate annual reporting for captives. Question 12. Scenario-based. Topic: Risk financing alternatives. A Kentucky-based manufacturing company is considering forming a captive insurance company to manage its workers' compensation risks. Management is evaluating whether a captive is the most suitable risk financing tool. Which factor would most strongly support the decision to form a captive? A. High frequency and low severity of workers' compensation claims. B. The company operates in multiple states with varying insurance regulations. C. A desire to transfer all risks to third-party insurers. D. Minimal existing data on claims history. Answer. B. The company operates in multiple states with varying insurance regulations. Explanation. A captive allows the company to streamline coverage across jurisdictions, avoiding the complexity of dealing with multiple commercial policies. A. Incorrect. Captives are better suited for larger or more complex risks. C. Incorrect. Captives aim to retain and manage risk, not fully transfer it. D. Incorrect. Reliable claims data is essential to establish a captive. Relevant law guidelines. Kentucky's captive framework supports multi-state operations to address diverse regulatory environments. Question 13. Topic: Premium tax requirements. What is the premium tax rate for captive insurance companies in Kentucky? A. 0.3% on the first $20 million of direct premiums and 0.1% thereafter. B. 0.5% on all direct premiums with no cap. C. 1% on direct premiums capped at $100,000 per year. D. Captive insurers in Kentucky are exempt from premium taxes. Answer A. 0.3% on the first $20 million of direct premiums and 0.1% thereafter. Explanation: Kentucky applies a tiered premium tax rate to captives, promoting affordability while ensuring tax compliance. B. Incorrect. The rate and structure do not align with Kentucky statutes. C. Incorrect. The actual rate is lower and capped differently. D. Incorrect. Kentucky does impose premium taxes on captives. Relevant law guidelines. KRS 304.49 outlines premium tax rates for captive insurers. Question 14. Topic: Governance standards for captives. What is the minimum number of board meetings a Kentucky domiciled captive insurer must hold annually? A. None of board meetings are optional. B. At least one meeting within the state of Kentucky. C. 2 meetings with at least one involving all directors physically present. D. 4 meetings to review quarterly financials. Answer B. At least one meeting within the state of Kentucky. Explanation: Kentucky law requires at least one board meeting to be held annually within the state, emphasizing local governance. The incorrect meetings are mandatory under Kentucky law. C. Incorrect. While frequent meetings are good practice, only one is mandated. D. Incorrect. Quarterly meetings are not legally required. Irrelevant law guidelines. Governance requirements for Kentucky captives are specified under KRS 304.49. Question 15. Topic: Claims reserves evaluation. Why is it important for a captive insurer in Kentucky to conduct actuarial evaluations of its claims reserves? A. To inflate reserves and avoid premium taxes. B. To meet statutory solvency requirements and ensure adequate funding. C. To allocate surplus funds for parent company operations. D. To reduce the frequency of claims by external parties. Answer B. To meet statutory solvency requirements and ensure adequate funding. Explanation: Actuarial evaluations ensure the captive has sufficient reserves to meet future claims obligations, satisfying regulatory solvency standards. A. Incorrect. Inflating reserves for tax avoidance is illegal. C. Incorrect. Surplus funds cannot be misused for non-captive purposes. D. Incorrect. Reserve evaluations focus on financial readiness, not claim prevention. Relevant law guidelines. Kentucky regulations require regular actuarial reviews of reserves. Question 16. Topic: Reinsurance for captives. What is one advantage of reinsurance for Kentucky captives? A. Avoiding all regulatory oversight by the Kentucky Department of Insurance. B. Increasing capital surplus requirements. C. Reducing the captive's exposure to catastrophic risks. D. Limiting underwriting to only low-risk policies. Answer C. Reducing the captive's exposure to catastrophic risks. Explanation: Reinsurance helps captives manage large or unpredictable risks, ensuring financial stability. A. Incorrect. Regulatory oversight remains mandatory. B. Incorrect. Reinsurance does not increase capital requirements. D. Incorrect. Captives can underwrite various risk levels with reinsurance support. Relevant law guidelines. Kentucky encourages captives to use reinsurance for effective risk management. Question 17. Scenario-based. Topic: Captive insurance feasibility. An energy company based in Kentucky is evaluating the use of a captive insurer to cover environmental liabilities. Stakeholders are concerned about fluctuating cleanup costs. What is the primary benefit of using a captive in this scenario? A. Reducing cleanup costs through external grants. B. Stabilizing insurance costs for long-term liabilities. C. Avoiding all regulatory requirements for environmental coverage. D. Eliminating the need for third-party claims adjusters. Answer B. Stabilizing insurance costs for long-term liabilities. Explanation: A captive provides tailored coverage, allowing the company to better manage and predict insurance costs for long-term risks. A. Incorrect. Captives do not directly reduce operational costs. C. Incorrect. Regulatory requirements still apply. D. Incorrect. Third-party claims management may still be utilized. Relevant law guidelines. Captives are ideal for long-term liabilities requiring cost predictability. Question 18. Topic: Dividends from captives. Under Kentucky law, when can a captive insurer pay dividends to its parent company? A. Any time without prior regulatory approval. B. Only after obtaining approval from the Kentucky Department of Insurance. C. At the end of every fiscal quarter. D. When reserves exceed claims by at least 50%. Answer: B. Only after obtaining approval from the Kentucky Department of Insurance. Explanation: Dividends require regulatory approval to ensure the captive maintains sufficient reserves and financial stability. A. Incorrect. Dividends without approval violate Kentucky law. C. Incorrect. Timing of dividends is not fixed. D. Incorrect. Reserves adequacy is determined by regulators. Relevant law guidelines. KRS 304.49 mandates regulatory oversight for dividend distribution. Question 19. Topic: Investment regulations for captives. What is a key restriction on investments for Kentucky captives? A. Captives cannot invest in foreign securities. B. Investments must align with conservative asset allocation standards. C. Captives are prohibited from holding real estate assets. D. No restrictions exist. Captives can invest freely. Answer: B. Investments must align with conservative asset allocation standards. Explanation: Kentucky requires captives to follow prudent investment practices to safeguard financial stability. A. Incorrect. Captives may invest in foreign securities under certain conditions. C. Incorrect. Real estate investments are not outright prohibited. D. Incorrect. Investment freedom is subject to regulatory limits. Relevant law guidelines. Investment guidelines are outlined in Kentucky's captive regulations. Question 20. Topic: Captive types. Which type of captive is designed specifically for a single parent company? A. Group captive. B. Pure captive. C. Association captive. D. Renter captive. Answer: B. Pure captive. Explanation: A pure captive serves only one parent company, providing tailored risk management solutions. A. Incorrect. Group captives serve multiple entities. C. Incorrect. Association captives are for groups with shared risks. D. Incorrect. Renter captives are used by multiple unrelated entities. Relevant law guidelines. Kentucky laws recognize various captive structures to address diverse business needs. Question 21. Topic: Capitalization requirements for captives. What is the minimum capitalization requirement for a pure captive in Kentucky? A. $100,000. B. $250,000. C. $500,000. D. $1 million. Answer: B. $250,000. Explanation: Pure captives in Kentucky are required to maintain a minimum capitalization of $250,000 to ensure financial solvency. A. Incorrect. This is lower than the legal requirement. C. Incorrect. This applies to other captive types, such as group captives. D. Incorrect. This amount exceeds the required minimum for pure captives. Relevant law guidelines. KRS 304.49 specifies minimum capital requirements based on captive type. Question 22. Scenario-based. Topic: Tax implications for captives. A Kentucky-based retailer forms a captive insurance company to handle its general liability risks. The retailer wants to take advantage of federal income tax benefits available to captives. Which condition must the captive meet to be eligible for favorable tax treatment under U.S. tax law? A. It must insure only third-party risks. B. It must meet the risk shifting and risk distribution criteria. C. It must be domiciled outside the United States. D. It must pay no claims during the first year of operation. Answer: B. It must meet the risk shifting and risk distribution criteria. Explanation: To qualify for tax benefits, the captive must demonstrate risk shifting, transfer of risk to the captive, and risk distribution, spreading risks among multiple entities or exposures. A. Incorrect. Captives can insure parent company risks while meeting tax criteria. C. Incorrect. U.S. domiciled captives can qualify for tax benefits. D. Incorrect. Claim history does not affect tax qualification. Relevant law guidelines. IRS Revenue Ruling 2002-89 outlines these criteria. Question 23. Topic: Types of captives. Which type of captive is designed to allow unrelated entities to participate in a shared insurance program? A. Pure captive. B. Association captive. C. Group captive. D. Protected cell captive. Answer: C. Group captive. Explanation: Group captives serve unrelated entities with similar risk exposures, enabling cost-sharing and risk management collaboration. A. Incorrect. Pure captives serve a single parent company. B. Incorrect. Association captives serve entities within a common industry or association. D. Incorrect. Protected sell captives separate risks for participants but do not require shared ownership. Relevant law guidelines. Kentucky law recognizes multiple captive structures, including group captives. Question 24. Topic: Risk retention groups. What distinguishes a risk retention group (RG) from other types of captives in Kentucky? A. RRES can write reinsurance but not direct insurance. B. RGS are exempt from all state regulations. C. RGS are formed under the Federal Liability Risk Retention Act of 1986. D. RRGS are only permitted for health insurance coverage. Answer: C. RRGS are formed under the Federal Liability Risk Retention Act of 1986. Explanation: Outlet GS are under federal law, allowing them to provide liability insurance across state lines with limited state regulatory oversight. A. Incorrect. Outlet GS write direct insurance. B. Incorrect. State regulations still apply in certain areas. D. Incorrect. Outlet GS can insure various liability risks, not just health insurance. Relevant law guidelines. The Liability Risk Retention Act governs our RG operations. Question 25. Topic: Kentucky Department of Insurance role. What is the primary role of the Kentucky Department of Insurance in regulating captives? A. Auditing every claim filed with a captive insurer. B. Setting premium rates for captives. C. Monitoring compliance with financial and solvency standards. D. Managing the day-to-day operations of captive insurers. Answer: C. Monitoring compliance with financial and solvency standards. Explanation: the department ensures captives meet statutory requirements, including solvency and reporting, to protect policyholders. A. Incorrect. Claims are managed by the captive, not the department. B. Incorrect. Captives set their own premium rates. D. Incorrect. Captives operate independently of the department. Relevant law guidelines. Kentucky Revised Statutes KRS 304.49. Question 26. Scenario-based. Topic: Reinsurance strategies. A Kentucky-based captive insurer wants to limit its exposure to catastrophic risks from a single insured event. What strategy should the captive employ? A. Diversify its portfolio with unrelated risks. B. Purchase excess reinsurance coverage. C. Increase its premium rates significantly. D. Merge with a commercial insurer. Answer: B. Purchase excess reinsurance coverage. Explanation: excess reinsurance helps protect the captive from losses exceeding a specific threshold, ensuring financial stability. A. Incorrect. Diversification is helpful but does not address large single event risks. C. Incorrect. Higher premiums may not reduce exposure. D. Incorrect. Mergers are complex and not a direct solution to catastrophic risks. Relevant law guidelines. Kentucky encourages captives to use reinsurance for effective risk mitigation. Question 27. Topic: Audit requirements. How often must Kentucky domiciled captives undergo an independent financial audit? A. Quarterly. B. Annually. C. Every 3 years. D. Only at the time of incorporation. Answer: B. Annually. Explanation: annual audits ensure captives remain solvent and compliant with Kentucky regulations. A. Incorrect. Quarterly audits are not required. C. Incorrect. Audits must occur more frequently than every 3 years. D. Incorrect. Ongoing audits are required beyond incorporation. Relevant law guidelines. KRS 304.49 mandates annual audits for captives. Question 28. Topic: Dividends and surplus management. What condition must be met for a Kentucky captive to pay dividends from surplus funds? A. The surplus must exceed liabilities by at least 25%. B. The Kentucky Department of Insurance must approve the payment. C. All claims must be settled for the current fiscal year. D. Dividends can be paid without restrictions. Answer: B. The Kentucky Department of Insurance must approve the payment. Explanation: dividend payments require regulatory approval to ensure the captive maintains adequate reserves. A. Incorrect. Surplus requirements are more complex than a simple percentage. C. Incorrect. Claims history does not determine dividend approval. D. Incorrect. Dividends cannot be paid freely without oversight. Relevant law guidelines. KRS 304.49. Question 29. Topic: Legal action against captives. In what jurisdiction can legal action against a Kentucky captive insurer be initiated? A. Only in the state of incorporation. B. Any U.S. state where the policyholder resides. C. The federal court system exclusively. D. Kentucky, unless otherwise agreed in the policy terms. Answer: D. Kentucky, unless otherwise agreed in the policy terms. Explanation: Legal jurisdiction for captives is typically the state of domicile unless the policy specifies otherwise. A. Incorrect. Policy terms may extend jurisdiction. B. Incorrect. Jurisdiction is not determined solely by the policyholder's residence. C. Incorrect. Federal courts are not the default venue for captive disputes. Relevant law guidelines. Kentucky insurance statutes govern legal actions involving captives. Question 30. Topic: Insurance lines allowed. Which line of insurance is prohibited for Kentucky captives to underwrite? A. Workers' compensation. B. Property insurance. C. Life insurance. D. Professional liability. Answer: C. Life insurance. Explanation: Kentucky captives cannot underwrite life insurance due to regulatory restrictions. A. Incorrect. Workers' compensation is permissible. B. Incorrect. Property insurance is allowed. D. Incorrect. Professional liability is also permitted. Relevant law guidelines. Kentucky law specifies restricted insurance lines for captives.